Bloomberg Audio Studios.
Podcasts, radio, news.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Let's turn to those retailers. I mean, Dollar General, the numbers came in below expectations. Guidance below expectations. Stock well below expectations. The stock's down 28% today, hitting an all-time low. My question, Emily, and we'll talk to Jen Bartashus. She's at Bloomberg Intelligence. My question is just the consumer versus Dollar General specific. So, Jen Bartashus, Bloomberg Intelligence, thanks so much for joining us here. I'm trying to get a sense, Jen, of kind of how much of this is just the lower-end consumer facing economic headwinds versus Dollar General just doesn't have it together in terms of good stores, good product, good inventory management. Help us break it down.
Yeah, good morning, Paul. So when we're looking at Dollar General, we do think a lot of their current troubles are self-inflicted. There's no doubt that the low-income consumer is under pressure, but this is their core consumer that they know better than anybody else. And the fact that they're misreading where that consumer is and not ready to serve them in the way that they need to be served is a little bit concerning. So we're looking for, they're saying that they're going to increase, spending on promotions. They're going to mark down prices, try to get customers back into stores. But we'll be really watching them for the rest of the year on how they execute against those plans.
So John Tucker was talking about how Dollar General needed to improve their store experience, perhaps take up a broom, get a mop. I mean,
just like once a week, maybe somebody clean the store.
How much of this is actually about the products that they're offering versus the in-store experience when we talk about Dollar General trying to lure customers back in?
It's a great question. And having clean, safe, well-lit stores is a basic of retail. When Dollar General says they're executing on a back-to-basics strategy, that should be part of that strategy. We've all seen reports of just, boxes piled in the aisles and unable to navigate, and consumers, not having a great experience in store. I think that is improving. It's just not yet at the pace where it's consistent across their entire chain, and where consumers are really responding to it.
Hey, Jen, if the consumer doesn't go to Dollar General, where does that consumer go? Well,
it's interesting, but we're seeing big market share gains at the likes of Walmart, also in the hard discount grocers like Aldi. Consumers are looking for where they're going to get the best deal, and whether that's on an everyday low price at something like a Walmart or an Aldi, or they're doing more cherry picking of deals, at regular grocery stores or other types of retail stores, buying things specifically on promotion in order to save money. So, Dollar General talked about not getting enough of the available share that's up for grabs. But part of that is that other companies like a Walmart are really executing well right now and are capturing more of those consumers.
Let's talk about the stock because it is down 28% right now, the worst intraday drop on record. Wow. What do you make of that move? Is that really justified today?
Well, that's a very, very steep drop. And I think part of the reaction is that in the second quarter, the kind of sentiment was that the turnaround plan was gaining traction. And all of a sudden, the bottom sort of fell out of that. And that's the response that you're seeing with the stock today. Is it as bad as, as the stock price might be saying? It's hard to say. I mean, they still had positive same-store sales. They still had positive traffic into stores. They seem to have a plan for how they're going to build on that in the second half. But it really, at this point, the message is that people want to see execution by the management team.
Hey, Jen, thanks so much for joining us. Really appreciate it. Jen Bartashus, she's a senior retail analyst for Bloomberg Intelligence. Let me tell you, folks, we asked Jen Bartashus to join us, 12, 13, 14 years ago, Bloomberg Intelligence. She was already a seasoned Bloomberg executive, and she's like, I'm not a research analyst. We said, no, you're really, really smart. We'll teach you how to be a retail analyst. And sure enough, here we are, and she's one of the leading voices on Wall Street. We appreciate getting a few minutes of her time. She really knows the retail space, helping us break down the Dollar General stuff, so we appreciate that.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Let's check in with Dan Morgan. He's a senior portfolio manager, Synovus Trust Company, joining us on Zoom from Atlanta. Hey, Dan, what did you make of the Nvidia earnings last night, the conference call, all of that?
Well, I have kind of a little bit more of a positive bias view towards the stock than maybe the rest of the street does. You have to bear in mind that we added Nvidia to our buy list back in about 2018, 2019. Nice. When they were really gaining a lot of momentum in the data center space, kind of gaining market share against the likes of AMD and Intel. And up to that point, as you know, they were construed as a company that produced chips that were going into, various video games that people played. And, they had a big spike in their demand during COVID, and then it kind of pulled back on that. And then obviously the whole thing flipped where their data center revenue became far greater than the gaming unit. And then the AI thing exploded about, a couple of years ago. The rest is history. So, overall, to be honest with you, I think this is a stellar report. I think the street has just gotten to the point where they've become so spoiled with these huge, colossal beats that NVIDIA's put together the last 4 or 5 quarters that their expectations have just gone off the ray. I mean, even if you look at this number they did on the third quarter, they topped the consensus estimate. Obviously, there was whisper numbers of 33 and 34 billion. But, let's face reality, it was a strong number, 32.5 billion. So I think everything is still on track with NVIDIA to ship the Blackwell chip out next year in volume. And I would expect margins to continue to rise because the average selling prices on these Blackwells are anywhere from 25, to 35,000. It's far greater than what they're getting on the Hopper and the H20s.
Talk a little bit about some of the production issues that NVIDIA is having with the Blackwell chips, and what did you learn from this earnings report about how quickly those can be resolved?
Well, Emily, that's been one of the big issues. Also, supply constraints as they try to build out this network of suppliers to kind of ramp up for Blackwell. I think it was kind of expected that this upcoming October quarter that there would be some shipments out, but it's not going to be in volume. They're still going to be relying on the H20 and the H200 like they did in this quarter, really to really post huge gains. I just think it's growing pains. I really am not concerned about it. I think they'll work through it. They've done a dynamite job back when we were having huge supply constraints in the overall chip sector. You all probably remember trying to buy a new automobile and you couldn't get a chip to go in a new car. I mean, they worked through that and still did very well. So I think they'll get through this hurdle and they'll start doing volume probably, like I said, first half of 25. So again, Emily and Paul, you're asking the wrong guy, right? Because I'm an eternal NVIDIA bull. So.
Hey, Dan, far be it for me to call you an old man, but you've been covering this tech industry for a long time. Where are the competitors here? That's kind of my question. I would think with this, we'd see the AMDs of the world and some others, really, Intel, even Intel maybe. Why does NVIDIA have seemingly such a stranglehold on this part of the market?
It's interesting, Paul. When I started really, diving into the stock and covering it very closely, sitting in on the developer conferences and all the conference calls, they would mention AI. They talk more about Omniverse. And then, of course, the AI thing took off. And they, by the way, we're 70% of the AI market. They would mention that in their public release, and nobody would care. But you're right. Everybody else has been extremely late getting to the table. You've got AMD with their MI300 chips. You've got Intel rolling out their Gaudi 2, Gaudi 3, and their Falcon Shores next year. But again, that's in 25. Marvel has the PAM DSP chip. You probably covered on your show about Huawei coming out with their Ascend 910C chip to compete against the H20. But, Paul and Emily, where the real competition may come in is from the hyperscalers who are their top purchasers, right? About 50% of their revenues come from them with their own internal chips. We know that Meta, we know that Google has the TensorFlow chip that they developed with Broadcom. They are on version 6 right now. I think there's a dual chip coming out called Athena that they're working on also. So there's a lot with AMD. There's a lot of things going on internally where these hyperscalers are trying to become less reliant on Nvidia. But quite frankly, guys, the chips they're coming out with still aren't going to top the performance they're going to get out of Blackwell. But they could use it for lesser capability, tasks, so to speak, and try to save some money from, as I mentioned before, the average selling prices are very high on these newer chips.
So revenue doubled in the quarter, Dan, but yet the stock is down this morning. I'm just wondering, I know you said that investors might be getting a little spoiled. What do we need? Like, what does the street want to see out of Nvidia then to move this stock up higher if revenue doubling isn't enough?
Yeah, I mean, again, Emily, it's perplexing for me. I mean, like you said, you look at the revenue year over year, it was up, a huge amount, 122%. You had the data center group, which was up 154%. I've got the data center group going over $100 billion in revenue for 25 compared to $44 billion in 24. So that's more than a double just in that unit. So again, this has become such a momentum stock, right? I mean, it trades at 60 times price to book. The Philadelphia Stock Exchange Index trades at 6 times book. It's a trailing 75 times earnings. So you have this massive multiple, this huge momentum. You have this situation where you can't make any errors at anything that you're reporting. Otherwise, you're bringing the stock down. So again, I just think, quite frankly, Nvidia has kind of spoiled investors, since that dynamite quarter about 2.5 years ago. And people just keep raising the bar, and they're never satisfied. But they're still doing really well.
Hey, Dan, you raised for me what I think would be the biggest risk, which is my customers are going to develop their own chips. Frame that risk out for me, and how do you think about that?
Yeah, I mean, that is a risk. Every single hyperscaler, as I mentioned, has their own chips. Probably the best chip out there is going to be coming from Alphabet and the Broadcom joint venture with their Tensor version 6, what they're bringing out. So, that's the worry. Even Apple has their own chips now. So the worry is that instead of buying all their chips from NVIDIA, or 80-90% of chips from NVIDIA, maybe a little bit from AMD, let's say, or Marvel, they may start, keeping 30-40% in-house and saving money and using their own chips. So that does potentially slow demand down for NVIDIA chips in the data center space. However, if you're probably someone in charge of this for NVIDIA, you're saying, well, guess what? We're starting to get demand from other sources, right? Enterprise, we've got demand from Tesla. They talk about different governments who are now buying data center chips for their own use. So you could make a case that, maybe you're going to lose a little bit from the homegrown stuff coming from the hyperscaler, but then you're going to be able to grow it out by the fact that you're going to get greater demand from these other markets that you're not getting right now. So,
it's I
mean, there's a lot of moving parts, but I mean, I still feel, Paul and Emily, that we're at the beginning of this ride out. And, the key to making money in technology, and Paul, you alluded to the fact that I've been in this for a long time. I've been writing research and following and buying tech stocks since 1990. The key is to ride a wave. And if you ride a wave, it always goes up and then rides out. And, in the early 90s, you had the big, movement towards the internet.
Right,
you had everybody going to a mobile phone. If you caught one of those waves at the right stock, you did great. So
exactly.
You're on an AI wave in the chip space right now with NVIDIA.
Very good. Dan Morgan, thanks so much for that. We really appreciate getting a few minutes of your time. Dan Morgan, he's the senior portfolio manager, Synovus Trust Company down there in Atlanta. He was early on NVIDIA. He was right on NVIDIA, and it's been a heck of a run. The stock just this year up 142% year to date.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Graffeo sitting in for Alex Steele. I'm Paul Sweeney. We're live here in our Bloomberg Interactive Brokers studio. We're streaming live on that internet thing that Gene Munster keeps talking about. I think you go to youtube.com and search Bloomberg Podcast, and I think that's where you'll find us. I'm not really sure. You'll know that one of the topics that Alex Steele and I like to talk about, Emily, is commercial real estate. Because it's just fascinating how that industry is adapting to a post-pandemic world, particularly in the office, but also just across the board in commercial real estate and what it means for the banks and all that kind of stuff. Fortunately, we've got a lot of good folks to help us figure out what's going on. And Abigail Doolittle, I mean, she covers all the markets for Bloomberg News, but she's been really helpful in bringing some smart commercial real estate people into Bloomberg Radio, and we appreciate Abigail. She joins us here in our studio along with Scott Kelley. He's the founder and CEO of Aetos Capital Real Estate. Scott's one of these guys, he's part of that Morgan Stanley real estate mafia. They're everywhere. Anytime you see a commercial real estate person come in here with some money in their pockets talking to investing, they did a stint at Morgan Stanley Real Estate, and they just the best on the street as long as I've been on the street. Scott, thanks so much for joining us here. I guess my question is simply, where do you guys see the best value and opportunity in commercial real estate today? Are you going to the Lipstick Building or something like it on 3rd Avenue that's dealing with occupancy issues, or are you looking at other places?
Well, I'd make 2 points. One, people have been, us included, anticipating this distressed wave of real estate, which has not come as quickly as folks thought, but it's also inevitable. Okay. Just because the refinancing rates are totally disconnected from the underwriting of a bunch of these properties. So the answer is no. We're focused on value, places we can add value, and we've got a new company called Wavertree Property Partners, which we've got development capabilities from guys that were with the LaFrac family for a long time. I mean, they're good developers. We think that the combination of financial expertise and redevelopment is going to be the key to making money going forward.
So a question that I have, Scott, is that we've all been waiting for this crash in commercial real estate, and there were some big headlines in 2023. There were some big office buildings that were defaulted on. But since then, there really hasn't been that much. It seems like properties are still not trading, maybe a couple here or there. Is that true? And is there going to be a moment where all of a sudden a ton of properties are going to flood the market, or is it just going to take a really long time to work this thing out?
Well, your observation is absolutely true. You know, again, people have been waiting for the tidal wave of stuff to happen, and
where is it?
There's a billion. Well, there's $1 billion loan portfolio on the market right now from a foreign bank that's just getting out of everything, and some of it's performing, a lot of it's not. There are a couple more coming later this year, but interestingly, as we discussed previously, so much of this bad debt is held in regional and community banks, and they're just extend and pretend. They're renegotiating the terms, they're putting out the maturities. They're never going to get repaid.
How long can they do that for?
Well, I think it's a regulatory matter. I think the regulators don't want to cause a banking crisis in an election year. So I think the thing that changes is after the election, the regulators start to, and again, this bank that's selling $1 billion portfolio, it's because it's a European bank, and it's because the European regulators are saying, get rid of this trash. So I think that doesn't happen until after the election. But after the election, I think it really does.
Interesting. So 2025 could be kind of painful.
Yes.
We've been talking a lot about Nvidia today and this hunger for AI and demand. I'm wondering how that is impacting commercial real estate. Are you seeing opportunities in data centers?
Well, yes. I mean, data centers are one of the big. Again, real estate. If you want to go by category, office has got issues, retail has got issues. Increasingly, apartments do to some extent, but data centers have just been on fire, and there continues to be an almost unquenchable demand for data center capacity. So yeah, I do think the bigger opportunity with AI and real estate, which we're working on with a partner, is to really synthesize the information in a way that help you make not just good commercial judgments, but informed commercial judgments, data-driven.
Scott, you've been in this business for decades. You and your team, everybody knows you. Every banker knows you. Every lender knows you. When you go out to buy a property today, you're the equity. Can you get a loan for your capital structure? Are the banks lending?
Well, that honestly is the big issue. That yes, the banks are lending, but at terms which are radically different than most of the current owners anticipated. So, somebody that has borrowed money at 3%, all of a sudden they get a term sheet back from the bank and it's 7 or 8% at the same loan to value ratios. So that's what inevitably is going to cause a big turnover and a repricing of the industry. It just hasn't happened yet. And the subordinated lenders are in control of all these situations when that debt matures. It's just that, rather than pull the trigger right now, the banks, I think, have been encouraged to push it out for a year or two. So the problem is profound. It's identifiable. It's just going to take a while to come to fruition.
I'm so interested in what you were saying about the regional banks, because when you joined us about a year ago, you were saying that you thought that there could be a crisis. So once we put this election past us, has enough extend and pretend happened that 2025 might not be awful? Do you think that there could be a regional banking crisis if the regulators wake up?
Well, I think it's going to take, as we talked about, a year. I think this is going to be a slow burn. I mean, this isn't an RTC type situation where they're going to, liquidate basically the government liquidated the whole savings and loan industry. So it was a huge opportunity that probably lasted 24 months. This is not going to be that way because this debt is all over the place. It's in really, bad refinancing, condition, but it's going to be a slow burn as opposed to everything happening at once. So I think the answer is there's going to be a lot more distress in 25, but the opportunity is going to last for a while for an investor.
Scott, here in New York City, there's so many families that are just own so much real estate here in New York City. They've been so successful over generations. Any of them stressed right now? Really financially stressed?
Some that have been more active developing recently. I'm not going to tell you who, but yes, there are. The long-term owners who've owned for a long period of time. If you look at the New York market, if you own good office properties, as an example, the one thing that's really happening in the office market here is that all these buildings are being heavily amenitized. You look at the 3-star restaurants, the gyms, the places for tenants to hang out. That's the way that the classic, really high quality office buildings have been able to retain their tenants, and they're really in pretty good shape. A lot of those are owned by REITs, which tend to be low leverage, and a lot of these families don't have a lot of leverage. The people that are stressed are the ones that have levered up to do new developments, recently, particularly in the office space, that just haven't worked out. But there is going to be the winners and losers. That if you have, Class B, C office buildings, those are going to be really tough. Where the Class A ones continue to perform pretty well.
Just 30 seconds. What percentage of New York real estate would you characterize as Class A?
10, 15.
See, that's my point. I think this is going to get ugly. That's what I keep waiting for. And we just haven't seen it, thankfully.
It's amazing.
I don't know. I don't know how it's going to play out. I don't know. But here on Bloomberg Intelligence, we're going to continue to cover this commercial real estate business because we think it's really interesting. We've got smart people like Scott Kelley, founder and CEO of Aetos Capital Real Estate. He's also Waiver Tree Property Partners, managing member there. And then our good friend Abigail Doolittle, markets reporter for Bloomberg News. Abigail's got so many great relationships here, and we appreciate her sharing them with Bloomberg Radio here. Talk about the commercial real estate business. I don't know.
It's all about gyms and offices.
I guess. I don't know. Back in the day, I came in at 9 o'clock. We worked till like 10 or 11 o'clock. We got dinner and a car home, and that was just plenty.
Now you need a sauna.
I know. Now I need a sauna.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Let's switch over to Nvidia here. I mean, stock's down 2.6%. I don't know. I thought the numbers were darn good. I need some perspective on this name. I need some perspective on AI because to me, and I think for a lot of listeners, a lot of viewers, AI is still something new. It's a new technology. I'm not really sure what it is. But our next guest has been really helpful in explaining what AI is and explaining what the opportunities are, and that is Gene Munster. He's a managing partner and co-founder of Loop Ventures, one of the leading voices, in my opinion, on all things technology. Hey, Gene, thanks so much for joining us. Can you give us your take on what we heard from NVIDIA last night and how we should think of NVIDIA and AI going forward?
Well, my take starts with what is a misunderstanding related to, I think, the narrative around this quarter and the guidance specifically. And the narrative is that the guidance is not as exciting as it was in the past. And so a few months ago, when they reported their April quarter, they guided the out quarter, the July quarter, up by 5.2%. So that's kind of the bogey. That's how investors thought about this October guide last night. And they only guided October up by 2.5%. And that diminishing return effectively on the upside is something that has dominated, I think, this view that that the second derivative is not working in the advantage of NVIDIA. That's just not, the beats are not, the raises are not as exciting. But that view misses a critical point. And it is very clear, even though they were not clear on the call, that this Blackwell chip, this next generation chip, was delayed by 3 months. And if you go back and listen to their earnings call 3 months ago, they were very clear. They used the word ramp in October. That's when the revenue was going to ramp for Blackwell. And now they're saying that that is going to ramp in the January quarter. So, Paul, if you take that revenue and basically bring it back into the October quarter, it's about $3 billion in revenue, they would have actually raised revenue by 12%. And I think, so that's an acceleration from the 5% raise that they did 3 months ago. I think that is, the reality is that this business continues to accelerate nicely.
Gene, I think intuitively, investors, when they see a stock that's run up so much so quickly, they get nervous that we've hit euphoria, we've hit peak AI. What are you telling, those investors who are just skeptical of just how quickly this stock has moved up higher? What are you telling them? Because you are still owning NVIDIA at Deepwater.
That's right. We still own this. And I would tell them, I would just ask a question about just fundamentally, how do they see AI playing out over the next several years? And if you believe that this is going to be truly transformative, more than, for example, the smartphone or the internet, I would tell them that just continue to stay the course. This is a rocket ship. You can debate whether you have a window seat, and that would be akin to your entry price to NVIDIA, or an aisle seat. But either way, this ship is going to continue to go up, because at the end of the day is that in order for AI to come to its full capacity of general intelligence and eventually super intelligence, we need to scale. And scale requires not only more compute capacity, but more data. If you continue to need more compute and data, then NVIDIA is going to be a beneficiary of that. And so we also have a venture investing business. We invest in technologies. Some of them compete with what NVIDIA is doing. And we know from that side how difficult it is to close that gap. And so I think they will continue, the market will continue to need their chips to enable what I think is a very robust outlook for AI. And just to put a final thought on, Emily, is that I think we're in a 3 to 5 year bull market. Still early. I don't think we're even close to a peak. I understand why people are nervous when you see the move in NVIDIA over the last couple of years, but I think it's an uncomfortable truth about this market is it's going to continue to go higher.
Hey, Gene, a reader just kind of piped up here and said, how about some of the competitors, like some of their customers might be competitors in terms of these chips? Frame that out for us.
So some of the customers make their own chips. Microsoft makes its own chips. You also have companies like Google has their Tensor chip. And so Amazon's working on different chips. And so these are the hyperscalers, and these are the parts of the business that have been kind of fueling a lot of the growth. And if you just think about in total how much of their growth has come from the hyperscalers. It's probably about 60% over the last year. And so it's been really important. At the end of the day is that I continue to believe that the hyperscalers will start to add some of their own chips. They still don't have the performance, and this is the central point. Just because you're creating a chip doesn't mean that it has the same performance as NVIDIA GPUs. And a big part of the call last night was Jensen trying to educate investors about how the hyperscalers think about the return on investment, and that there is a return on investment for buying these more expensive chips. And so simply put, Paul, is that just because they're working on chips doesn't mean that they are comparable to NVIDIA's GPUs.
Hey, Gene, thanks so much again for joining us. We really appreciate getting some of your time, helping us really understand what's going on out there in the world of technology and in this new phase of it, including AI. Gene Munster, he's a managing partner. He's a co-founder of Loop Ventures. He's based in Minneapolis. He's been covering the tech industry really for decades and gives us a good perspective on AI. And as I remember, Gene probably told us maybe a year ago, or maybe more than a year ago, kind of just how big AI is relative to things like, the internet and the electricity. And he puts it in that context, and that kind of gives you a good frame of reference for perhaps how big this AI can be for everyone.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Aside from Nvidia, Emily, another big tech story out there is ASML. The Netherlands plans to limit ASML Holdings' ability to repair and maintain its semiconductor equipment in China, a potentially painful blow to Beijing's efforts to develop a world-class chip industry. So that tech Cold War seems to be pretty hot out there these days. Let's get some latest on that. We'll do that with Sarah Jacob. She's an Amsterdam Bureau Reporter for Bloomberg News, joining us from Amsterdam via Zoom. Sarah, this seems like a pretty big step by the Netherlands government to limit ASML's business with China. Give us the background.
Well, essentially, the Dutch government will likely not renew certain ASML licenses to service and provide spare parts for its chip equipment when some of those licenses expire at the end of this year. The move is expected to cover ASML's top-of-the-line machines. So we're talking DUV machines, which are deep ultra lithography machines. We know that ASML's most advanced chip-making equipment are sold with maintenance agreements. So a decision to limit ASML's ability to repair and maintain those machines could make at least some of those machines inoperable in China as soon as next year.
And what was the rationale behind this ban?
Well, the Biden administration has sought to limit China's advances in the semiconductor sector for some time now, and it has implemented sweeping export controls on China on the sale of advanced chip making equipment, over citing national security grounds. So we have also previously reported that the Biden administration has raised the possibility of imposing the FDPR, which is essentially a rule that allows American officials to control the flow of foreign products built with even the tiniest amount of, technology originating from the US. And in this context, the US has sort of also been urging the Dutch government and many of its allies to align their China controls with the US. So that's sort of the backdrop for this move.
What percentage or how big is China for ASML? Because I'm looking at the stock. The stock's actually up today. I thought it would have been down maybe materially.
Well, China is, accounts for about half of ASML sales. So we do expect if this were to be announced, it would impact ASML sales. And these new curbs would put ASML under the same constraints that US peers such as, Applied Materials is experiencing. But the implications of such a move also is for China, right? It's in terms of obtaining more spare parts and maintaining machines are critical to the smooth operation of a chip plant. And China relies on ASML's immersion DUV lithography systems to advance its chip-making technology. So for China, it would be a blow in its efforts to develop its chip industry. It could make it difficult for Huawei and Semiconductor Manufacturing International Corp to make breakthroughs in their current capability.
Is this ban expected to then, if it's not going to be good for the Huawei's of the world? Is it better than for U.S. chip companies? Is that the idea here?
It's essentially just part of this broad, plan by the Biden administration and its allies to sort of limit China's advances. So that's the real goal over here. And ASML being, one of the largest and makes this most advanced chip making equipment that others don't have in the world is very critical in this whole plan across both the U.S. and the Dutch government.
To what extent, Sarah, is the feeling within the Netherlands that this is ASML just following U.S. policy versus maybe acting a little bit more independently? How willingly is ASML doing this?
Well, this is coming from the Dutch government. So the Dutch government under Prime Minister Mark Rutte, which was the previous prime minister, had resisted U.S. pressure to add additional restrictions on servicing, arguing that they needed more time to evaluate how the export bans had taken effect. But we say with the new administration, Dutch Prime Minister Dick Schoof earlier this month said the government has good negotiations with U.S. and Japan, and he expects they will end with good results. So we'll have to see.
Sarah Jacob, thank you so much for joining us. Really appreciate that. Sarah Jacob, she's an Amsterdam Bureau Reporter for Bloomberg News. How cool is it when you got news coming out of Amsterdam? We have a bureau there, and we have an expert right there that we can talk to. That is the power, folks, of Bloomberg News. Matt Winkler building that with Mike way back in the day, and we can tap into that for Bloomberg Radio. So some great stuff. Sarah Jacob, Amsterdam Bureau Reporter there on ASML.
This is the Bloomberg Intelligence Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 10 a.m. to noon Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.